Hi there. So in this video, what I'm going to do is I'm going to give you a very quick crash course in what options trading is and how you actually make money trading options. And then what I'm going to do is I'm going to give you a review of Larry Benedict's one ticker trader. And here's why I'm doing this video, because before you start trading options, you need to understand what options trading is and how you make money, because I'm assuming you're watching this video because you want to make either some extra money or full-time money options trading. But the thing is as well, once you understand it, you need to find stocks in order to trade options with. And the thing is, when you're new to options trading, you don't want to just pick random stocks. You need to follow an expert and get tips from them. And that's why I'm going to review Larry Benedict's one ticker trader for you, because Larry's got a very affordable service where he basically goes deep into options, but also gives you picks of stocks that you can then trade options with. So after this video, hopefully you can have a basic grasp of what options trading is, how to make money trading options, and also I'm going to give you a resource of where you can get options trading picks from, so then you can start trading options and start hopefully making some money. So with that said, let's get on with the video. So when people sort of start looking into options, people can find it very intimidating and very, very confusing, and I get it. I've got into options trading this year, and in the beginning, I just couldn't wrap my head around it. I didn't really understand it, found it very confusing, but you just need to give it time, because once you get your head around, what options trading is and how it works, a huge amount of opportunity comes your way, and you sort of see the opportunity. Because the beauty of options trading is you can trade it basically four ways, and I'll get onto that later on. But basically, you can essentially make money when the market or price of a stock goes up or the price of a stock goes down. And that's beautiful, because that allows you to make money no matter what the market conditions. And after this video, hopefully a little light bulb will go off in your head of basically how you can make money options trading. So anyway, let's get on, because I do respect your time. So what is an option? So basically, an option is a contract between two parties for the purchase or sale of an asset, which is the stock, at a specific price by a specific date. So basically, you've got two ways you can buy a stock. So if you want to just buy a stock normally, you go to your broker or your online app, pick a stock, buy it. You make money if the stock goes higher than the price you pay for it. You lose money if the price goes lower than the price you pay for it. With an option, it's kind of the same, but it's different. But with an option, you're using leverage. So when you buy an options contract to start trading a stock, you are not obliged to either buy or sell that stock you're sort of betting on. And this is the thing, and this is the beautiful thing about options, is that you never actually have to buy or sell a stock in order to make money. So basically, think of an option as a contract between two parties, where basically you're betting that the price of a stock will go up, or betting that the price of a stock will go down. But you'll understand it a little bit more, hopefully, as I get onto this video. So let's just look at an example. So basically, an options contract is an agreement between two parties. We've got Simon here, who's looking to buy a stock. He's betting on stock X, or he's going to take an option out on stock X. And we've got Chloe here, so Simon's going to be the option buyer and Chloe's going to be the option seller. So let's just say that on December 1st, stock X here is trading at $50 per share, and Simon and Chloe make the following agreement with an options contract. Simon can buy 100 shares of stock X from Chloe for $100 per share, which is a fixed price in the contract called the strike price, at any time before December 30th. So regardless of what stock X is trading on the stock market, Simon he can buy 100 shares from Chloe at $100 per share. In order for Simon to have this right, and as the obligation that Chloe is taking on, Simon has to pay Chloe $15, which is called the premium and is the option fee. And let's just look at, this is basically the terminology of an options contract you need to know. So when you take out an option contract and make an agreement, you've got an underlying asset which is being traded, which is we'll just call it stock X. You've got the strike price, which is $100, and the strike price is the fixed price in an options contract where the option buyer can either buy that stock or sell that stock at any time before the expiry date. In this case, it's December 30th. But for that benefit of having the right to buy or sell that stock, premium the option buyer has to pay, in this case Simon, is $15. Hopefully that makes a little bit of sense to you. So let's sort of break this example down. So Simon is the option buyer. He's trading stock X, or he wants the right to trade stock X, and this is Chloe, the option seller. So in exchange for $15, Simon, the option buyer, has the right to buy stock X for $100 per share anytime before December 30th. So Simon, the option buyer, pays the $15 premium to Chloe in order to have that right to buy these shares at any time before December 30th for $100. And obviously, I've said, has the right to buy stock X for Chloe at $100 per share. Chloe, the option seller, collects the $15 premium and has the obligation to sell stock X to Simon for $100 per share. Now, the important thing to understand here, with Simon buying this option, taking out the option for stock X, is buying the option, he's betting that stock X is going to rise above $100 per share before December 30th. And that is basically how he's going to make money. Stock X, price of stock X goes above $100. Simon will execute his option and basically force the option seller, Chloe, to basically sell him the stock for $100 per share. And then obviously, depending on what the price is above $100, that is going to be Simon's profit. Now, Chloe, on the other hand, is betting that stock X price is going to go down. And this is important because basically Chloe's profit is going to be the premium she collects from Simon. Obviously, if stock X doesn't arrive above $100 per share, Simon will not execute his right to buy stock X. He'll just let the options contracts expire worthless. Simon's loss is just going to be the $15 premium, and Chloe wins and basically walks away with a $15 profit. So that is basically what is playing out here, and hopefully that makes sense to you. So what are the different types of options you can trade? There's basically only two options, and also I must say there's only really two things you can really do with options. You can buy an options contract or you can sell it. So call options. Call option, when you take one out, gives the options buyer the right but not the obligation to buy a stock at a specific price by a specific date. Put option gives the option buyer the right but not the obligation to sell a stock at a specific price by a specific date. So let's just look at this grid to see how that plays out. So when you buy a call option, you have the right to buy the stock you're basically betting on. But in order to have that right, you must pay the option seller a premium. So when you buy a put option, you have the right to sell that that stock you're betting on, but you have to pay the option seller a premium. On the flip side of it, if you want to sell a call option on a stock, if that option is obligated or exercised by the option buyer, you'll have the obligation to sell that stock. But in order to have that, in order to take on that obligation, you collect the premium. And obviously, if you sell a put, you take on your risk is the obligation to buy that stock from the option buyer. But in order to have that obligation, you collect a premium. So how do you actually make money trading these options? So this is important to basically understand. So if you're bullish on a stock and you think the market or specific stock will go up in a set period of time, you will buy a call option. If you think a price of a stock is going to go down, and you're bearish on that stock, you will buy a put option, because basically, how this will work is that if a stock goes down below your strike price, you can buy that stock at the strike price and then obviously sell it, and then obviously you're going to be making a profit because that stock is trading below what you bought it for, or so you can sell it. And then obviously you can also sell call. If you sell a call option and you're bearish, you think the market will go down, you'll make money basically by collecting the premium. If you sell a put and you're bullish, you think the market go up on the stock, you'll make a profit, or you'll make your money when you collect the premium up front. So let's just wrap this up. The key takeaway to remember, regardless of whether it is a call option or a put option, an option buyer pays the premium and an option seller collects the premium. Just like in the real world, when you buy something, you pay for it. When you sell something, you collect money for it. And let's just put this, excuse me, into a key takeaway. When you buy a call option, you make money when the stock price of the option is higher than the strike price in the options contract. This is your profit. When you buy a put option, you make money if the strike price of the option is higher than the stop price. This is your profit. When you sell a call option, your profit is the premium you collected paid by the option buyer, assuming they don't exercise the option to buy at the strike price. When you sell a put option, your profit is the premium you collected by the option buyer, assuming they don't exercise the option to sell it at the strike price. So whilst there are only two options, these are only the 4 trades you can make with an option, and this is how you make money. So that is a complete crash course in options trading in about 12 minutes. Hopefully that makes sense, and hopefully, something's clicked in your head and you can see the opportunity of options and got a basic understanding of it. But the problem is, even if you understood it, at the end of the day, you got to pick stocks to trade. And when you're new, that is really, really hard and very risky, because if you start trading when you don't know what you're trading or understand it, that's gambling, and that's a recipe to lose money. And that's why I'm going to introduce you to Larry Benedict and his one ticker trader. Now, Larry Benedict is one of the world's leading options traders. He's been in the game for 35 years, and he's devised his own options trading strategy called the One Ticker Retirement Blueprint. And the big idea for that is that through Larry's strategy and system, he chooses one stock that he thinks will go up or down in a set period of time, so he can take an option out on it, whether it's a call or a put. But the thing is, he's not going to be trading dozens of stocks at any one time. Hones in on one stock, and when the signals are right, when he thinks the stock's going to go up or down, he'll open an option on it and start trading it. And it's a genius system and perfect for beginners. So what I'm going to do is just going to run you through what you get with one ticker trader. So basically, you get the issues and updates. This is where you get the buy and sell updates. So when Larry issues a buy update for a buy or sell update for a stock to take an option on, you will see it in here, as you can see here. You also get a monthly newsletter as well. You also get the special reports. This is Larry's Guide to Options, which is a complete crash course on options trading and how to trade options, how to open an account, and how to place an option, and all the terminology. And this is a one ticker retirement plan, which is Larry's options trading strategy, where he goes deep into how he uses his strategy, the one ticker retirement plan, to pick a stock and look for signals, so then he can buy it or sell it trading options. So I love these, absolutely awesome. I really enjoy reading these, and it's going to be great for you in order to start trading options. You get the portfolio, which are all of the stocks that have been traded. Then you got the videos here, basically how to place an options trade using Thinkorswim, the mobile app or the desktop app, which is Larry Benedict's recommended way of trading options. So that is basically everything you get with one ticker trader. I've been a member now, probably for about 6 months. I really enjoy it. It's really helped me understand options and basically start trading options, and I highly recommend it. Now, if you want to basically get one ticker trader and subscribe to it, I'll put a link down below, basically, so you can sign up to one ticker trader. Normally it trades for $1.99, but you can get it today for just $19, and that $19 will lock in your membership for a year, and for each subsequent year after that, if you decide to stay a member, you will only pay $19. And also you get a 60-day money back guarantee, so if it's not for you, you can request to get your money back. So that is my crash course on options trading, and also the one ticker trader. It's going to give you, picks of stocks that you can start trading with options in the examples that I've shown you, so you can start making money with options. Anyway, I hope you found the video useful, informative, and I'll speak to you soon.